Hi, everyone. Kevin McNew with Quantum Hedging with our weekly forecast for December 7th. Let's start first with corn. And with corn, our model is really like the upside. There's several factors that are driving that view from our model. One is just the time of the year. This time of year is normally a really bullish time of the year. In other words, we tend to go up more than we go down. Also, when we do go up, we tend to go up by more than the years we go down lose, if that makes sense to you. So it's really a good time to kind of favor the upside. Our model knows that. It's got that data in there from 30 years. But it's also saying, hey, there's some of these features. We have thousands of features that our model is looking at every week. There's some of these particular features that also amplify the seasonal effect. In other words, give us a little more bullish view. What are those features? Those are some of our key drivers that our model has found for this time of year that matter. One is technical indicators. Technical indicators, kind of come and go, and they kind of, will shift the dynamic. But our model is saying this time of year, there's certain indicators that our model likes that is kind of favoring that. There's other more common things that we in the trade know about. For example, the phase of the El Nino La Nina cycle, the INSO phase. That phase, this time of year, can be a really important factor, and it's shifting our model to say, hey, given what we're seeing in the waters along the equator, which measures this INSO phase, this is a good time of year to also be bullish. And then finally, U.S. corn production. That number got shifted down last month when we got the new USDA numbers, and that is helping a little bit. But for those of you that are also thinking ahead to January, that can also be a driver for where we go in the future. So our model isn't necessarily predicting what the future will be in January for corn production, but we're certainly expecting probably a lower corn production number, which is further fuel to the bullish story. But as of today and where we sit, our model says 71% chance of going higher between now and the first trade week in January 7th. So that's where we are with corn. With beans, it's a little more messy, not quite as confirming on the seasonal. Seasonal is really pretty mixed. It's 50-50. When we look at 30 years at this time of the year and look back the last 30 years, it's a 50-50 coin flip in terms of up or down over the next 30 days. On the other hand, up moves tend to be a little more up than the down moves tend to be down. So there's a little more up positive. Over 30 years, you gain about 1.5% in soybean prices over the next month. And our model, says, what, there's some things that make me less favorable of the upside. Right now our model has really been teetering back and forth, really just kind of staying neutral, which is in sharp contrast to where our model was back in early October. You can see, we were flagging pretty heavily from our model with really strong bullish signals. And we had a nice climb up. And once we reached that kind of climb up, our model really shifted to kind of downgrade and say, not much here to keep favoring the upside. And now our model's starting to say, yeah, the downside looks a little more likely as we move forward. So a more balanced 50-50 type of time of year for soybeans, but our model says there's enough chinks in the armor to maybe favor a little more downside. So it's a mixed bag. Corn looks positive, beans look slightly neutral to negative. And, the reality is we'll probably trade somewhere in between. So we'll see what the next month looks like. As always, we hope you enjoy this forecast. Visit us online at quantum-hedging.com to learn how we're embedding these cool products or these cool forecasts into products for grain elevators and farmers and investors as well. Have a great day, everyone. Thank you.